And on today's show, how advisors can use a life insurance review to create new business. Part 2 of this week's series on the life insurance policy review with policy due diligence expert and certified financial planner, Sam Rocke. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Sam.
Hi, Steve.
If you missed yesterday's show, Sam walked us through a gauntlet, I have to say, of different things that we're looking at, and we haven't even gotten into the big stuff yet, about policy reviews. Now, as a financial planner, and you're a certified financial planner, we should be doing annual reviews anyways.
Absolutely.
So now we're adding on a policy annual review. Now, is it really that much more work, Sam?
Not that much, really. It's not. That's something that we handle for you. Mm-hmm. That's something we handle for the advisor to say, let us do the heavy lifting, mm-hmm. let us review the policy, and you can go to your client mm-hmm. and be educated, be the professional, be the expert in the field, or at least be able to say that we've got a third party that is the expert in the field, mm-hmm. and here are some things that you should think about.
Well, when we're looking at a review, I notice on this chart, we're comparing CSO mortality tables from 1990 to the 2000, or actually the 58 and 80. And by the way, I came in this business on the 1958 CSO, where there was only two categories, smoker and non-smoker.
Right.
There wasn't these delineations and variations of super preferred, preferred plus, and so forth. So things have really changed in my world, and also interest rates have changed hugely from 1990 down.
Correct.
It's been a complete descent. This really matters to us when we're doing reviews, whether it's issued on the 58 platform or the 80 platform, or even, as you said yesterday, even the 2001 platform now, we're looking at cases that were built even on that.
Right.
That's how much it's changed.
Right.
So let's walk through some of this the basic ideas here. When I'm looking through underwriting, and this is where I'm thinking, how much underwriting do we do in a policy review? Are we just looking at the part 2 and we're just looking at the basic medical, or are we actually ordering APSs? What are we doing?
It depends a little bit about how specific we know that we need to get. If we know that there is a very difficult impairment, a cardiovascular issue, we might go out and request APSs. But what we do actually is what we call a discovery call. And this discovery call, somebody actually gets on the phone with the client, the agent will make the introduction, the agent will drop off, and then we'll have a 20 to 30 minute conversation about their medical history. I can say it's a lot better received than an advisor would typically think it would be, mm-hmm. And frankly, it's much better for us to be able to ask those questions than for the advisor. But we're going to go in and we're going to ask all the pertinent questions, the questions that we know knock out 90 to 95% of people for mm-hmm. traditional underwriting, or 90 to 95% of the issues that will help us to determine what carrier is best. We do.
Okay.
We have a form for it, and we have a team of professionals that know not only all of the pertinent questions to ask, but for all of the yes answers, they know all of the follow-up questions to ask, which is really big, mm-hmm. because an advisor might go and they might know to ask that question, mm-hmm. or they might know it's an issue, but then they're going to come back to us and say, well, so what do I need to know? Tell me about mm-hmm. the underwriting for this. And we might say, well, it could be a pretty wide range. Mm-hmm. Here's what we need to know to get more specific. And so it results in 2, maybe 3 or 4 conversations with the client, whereas if we do it, it's one conversation, mm-hmm. and we're getting a lot of specificity with, okay, what underwriting class to quote, because it's not a good situation when you quote preferred, and then you go through underwriting and the client signs a form and they get a paramed exam and go through a lot, and then you find out they're standard or table 2, mm-hmm. And you maybe have to take a new application to go to a new carrier, and they're paying 15 to 20% more, mm-hmm. whereas if you'd set the expectation at the outset, it might have been a much smoother mm-hmm. process.
When does the part 2 on an existing policy, because you're going to collect the existing policy if you can, mm-hmm. does that help you at all?
It does a little bit. It gives us a little bit of background, but ultimately, as we discussed yesterday in the show, things change. Things mm-hmm. change over 10, 15 years. A lot of these policies are at least 10 to 15 years old, some of them 20 or 30 or 40. Mm-hmm. And so the part 2 is, to your point, is very helpful, mm-hmm. but it doesn't tell the whole story. We really need an updated look.
I'm wondering, if I go through your system, through the questionnaire, I haven't still collected any APSs. I haven't went through any underwriting yet. I'm just collecting basic information to pre-qualify the case. Isn't that so?
Yes, that's exactly
And
it.
how much difference would you see? You've pre-qualified it. Were you pretty spot on when you got into the underwriting offer?
Our batting average goes way, way up when we do that, for sure. Yes, absolutely.
So it's really a positive issue to go through this process.
Absolutely.
We haven't went to APSs. We haven't went to a formal app yet. We're just trying to do some due diligence at the front end to pre-qualify
Right.
and help the advisor quote the right proposal.
Right. So really, Steve, we're doing a product review and we're doing an underwriting review. Both parts are really important. Because, like I said, things have changed. Things have changed in the industry. Things have changed for the client specifically.
And remember, beside the product and medical, they're also doing the planning strategy review to see if it still exists.
Right.
It's a huge issue. When we come back from the break, we're going to continue on why advisors should do an annual review along with all their other reviews that they do as a financial planner. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Welcome back to our second segment. I'm with Sam Rocke, expert in due care on policy review. I love your example here today. Why don't you walk me through this, Sam, and show what's going on here and give us the kind of yin and yang, the tale of two cities.
Right. So here you've got an old policy, and it's an old policy where it's a whole life. They were paying $20,000 a year, and they were projected to pay it for 10 years when the premium would vanish. This was an old vanishing premium based on.
What was the in-force ledger? It said 10 years. What was your in-force ledger?
Oh, probably. Well, at this point, it required 2 more premiums. So that's the policy at that time was probably 20 years old. So it was probably extended premium payments for an extra 10, 12 years for sure.
Wow, double what originally was proposed.
Right, well, because
Wow.
dividends back then were probably 10 to 12 to 13%, and dividends today are anywhere from 5.5% to 6.5%, depending on the carrier. So dividend rates have plummeted.
Do usually the client have a shock value on this issue?
Oh yeah, there's usually a shock value, but to be honest, Steve, a lot of clients have really forgotten. They've forgotten why they bought it. They've forgotten the conversations that they had. You know, maybe the advisor back then really disclosed it well and walked them through how it worked, but ultimately they've forgotten. They stuck it in a box. And
So I have this old policy then. $1,020,000 for 10 years. We know that's not going to be true. We just saw the in-force ledger. It was a shock to everyone's system. And you looked at the results. Now, also, we had a history of cancer. We had a rating here.
Right.
Then you brought it into the 21st century and the way you do policy review. Show us how you did it.
So today we were able to go and get them a very comparable rate class. They had a history of cancer. We were able to find them a carrier that was able to still see them as standard non-smoker.
Well, let me stop you there for a second. You really have carriers specific to certain cancers that are go-to carriers.
Absolutely.
I mean, we're in the brokerage market. We have over 80 carriers sitting in the brokerage market that own 85 to 90% of the market. But there are specifics by impairment and even subsets in cancer.
Right.
So you knew how to go to those carriers and see what you could do.
Yep, absolutely. Most every carrier has their underwriting manuals based off of a reinsurance manual, but most of the big carriers also have a proprietary manual where they're willing to go and take on additional risk by themselves in certain impairments. And we know specifically, okay, this carrier is going to be a little better with this impairment, so let's go there. And so this was the case here where we said, this carrier matches from a pricing and an underwriting perspective, and so we're going to go there. We're going to guarantee the policy with no additional premium. So there's no chance of going down the road and somebody saying, you know, I'm sorry, but things quite haven't worked out like we thought they would. So we're going to ask for more premium. That's not something that this new guaranteed product is going to do for your client.
This is a huge issue. If you're doing reviews and you know that people like Sam who live in this arena of due diligence on policy reviews and know the carriers to go to, that is a huge advantage. And look what we did for the client. Let's go to the male 72.
Right. So here's a scenario where this policy was sold, again, about 20 years ago, and the Universal Life assumed a crediting rate of 9%. So a 9% rate of return, whereas crediting rates now are at 3 or 4%, because in 1990 the Treasury was at 9 to 10%, and so at the time it was sold, $35,000 projected premium payable for 8 years. The policy is projected to lapse in 15 years. So a lot of people, they followed that natural vanish, or they followed the premium schedule that they were presented, and the policies simply are underperforming. They're blowing up. They're gonna lapse at a time when it's going to be really critical that they have it.
Well, how did you repair this then?
So we were able to get them preferred. He was standard in 1990 due to blindness. Today, we find that that's not really an issue. That's something that we can get over. And as you can see, standard back in 1990, there were really only 3 rate classes: standard, standard smoker, and preferred. Today, we've got preferred plus, preferred, standard plus, standard, preferred tobacco, standard tobacco.
We are really parsing a Chem 24 exam. Really,
right?
Really parsing it.
Right. We've gotten very, very specific. And so today we're able to get him preferred non-smoker with a new policy that guarantees his coverage, not projected, but guarantees his coverage for 20 years, which will likely take him
to his life expectancy. Wow. That to me is a huge issue. Now, when we look at these case studies, now we were looking at eliminating premiums, we're adding on guaranteed. When you go through some of these ideas, how much of this do you see on a regular basis that we can just, I mean, we say 65% of the policies can be improved, but they're not all taken as our suggestion. But over that number of 65, how much can we usually help the client?
Oh yeah, a huge number, because there are a lot of opportunities out there to improve a client situation. Sometimes, and there's 65% numbers. Some of those are slight improvement, but some of them are major. And if you can get a client on board to where they're going to say, "Look, I agree. I see the value in this. Let's do something about it," then we can almost always put them in a scenario where we feel it's a better situation. But frankly, we're not going to lead with replacement. We're going to lead with, we want to help you understand what you have, and then we want to come up with some recommendations to either maximize what you have or maximize a new product to better fit what you're trying to do.
Just remember, half of all Americans are in the wrong rate class and maybe using even the wrong product. That's all the time we have for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.